Hello, everyone, and welcome to the 21st episode of the Startup Boston podcast, where I interview entrepreneurs, investors, and influencers in the Boston startup community to uncover actionable advice and stories from their experiences. I'm your host, Nick Dupuy, and today's guest is Ken Cowan. Ken has made his way from a consultant to CEO of an automotive services company to an investor. Currently, Ken is an associate at OpenView Venture Partners, a venture capital firm that focuses on expansion stage software companies. Ken quit his first job at age 13, caddying at a local golf course because he found it too boring and quickly found a new job working at a startup organized and running tests on laptops. Since graduating from BC, Ken has mostly been involved with startups in some form and joined OpenView in 2016. In this episode, a few things Ken talks about are the issues expansion stage software companies run into, the pros and cons of being solely focused on software companies, the mistakes first-time founders make in the fundraising process, the metrics OpenView looks for when screening companies, and the differences between features and products. And remember, if you like today's episode, please subscribe to the podcast on iTunes and you'll get all of my new episodes as soon as they're released right on your podcast app. And remember that you can find all show notes at startupbostonpodcast.com. Enjoy today's episode. Ken, thank you so much for coming on the show today.
Happy to be here.
I'm interested in really digging in here and talking to you all about startups and venture capital. But first, can you tell us a little bit about your background?
Sure. So I'm an investor at OpenView Venture Partners here in Boston, and we're expansion stage software investors, mostly in SaaS businesses, and we invest all over the U.S. My own background is somewhat varied. Even for a VC, I have done everything from sorting cables in IT departments as a 13-year-old to kind of being on the revenue side, kind of running that for a startup. Have also been a financial consultant and have run the whole show. But I'm now here investing, and I'd say this is probably the most fun that I've had.
You have like a funny story, right, to your first job. I think I read it on your profile. You were hired, right, as a caddy, was it?
Yep.
And then you quit that because it was too boring.
Yes.
And then you were hired. Yeah, keep that story.
Yeah. So I was 13 years old, and it had become time to get a real job for once, and so I did. I went and got a job caddying at the local country club, and I don't dislike golf, but as soon as I was there, the very first day, I was thinking, this is really pretty boring. Sitting around and walking around these golf courses, and second day went by, third day went by, and it was like, mind-numbingly, face-meltingly boring.
Especially if you're not playing, right?
Exactly, and you're not playing. And the other thing is, I didn't know anything about golf. So it's not like I was a value-add caddy. I was the kind of caddy that went along with the guy, and he said the club, and I would hand him the club after looking at it to figure out what the club was. And ultimately just kind of said, you know what, end of the week, we're done here. Yeah. I don't remember if it was a week or 2 weeks, but it was not a long time. And so I need to do something else. So I found, through some connections, managed to land a totally unofficial gig because 13 years old. But basically going to a startup that was just needed some help kind of organizing laptops and sorting cables and stuff like that, running tests on ThinkPad. So, you're a 13-year-old and you're looking at all these computers, and, you don't have any sense of being able to buy anything at that point in your life. And so you're looking at all these computers like, oh my God, this is the coolest thing in the world. Look at all this hardware here. Meanwhile, it's 4-year-old laptops, doesn't mean anything.
Yeah.
Running just tests, making sure they work.
So how did you what was your path to venture capital?
So this is a tough one. Basically, I've spent my whole life from that moment on working in various startups and in various capacities, kind of anything from working in the company itself to kind of helping to advise the company, mostly nights and weekends. And, while in high school through college, I went to Boston College here locally, and about midway through college, kind of got the vibe which is pretty common for that kind of school, with a strong business school finance program, that it was time to go into quote unquote real job. And so for that meant time to go into finance. And so I found a job in New York City, kind of finance, and did that for about a year, it was fine. You learn a ton. It's always nice to be able to fall back on those Excel jockey routes. But it was also pretty boring and unfulfilling, and it's just nothing compared to the startup route. So I got midway through that. I had ended up kind of pressing around through my network to try to figure out what was next for me, and got an opportunity to go run a company actually out in Scottsdale, Arizona. And it was really interesting. It was a auto services company, super high end individuals, high end cars. So your Lamborghinis, your Bugattis, Ferraris, Porsches, Aston Martins kind of flavors, and dealing with trying to help and make kind of the lives of people who own these cars easier by taking care of them and moving them around around the country and around the local area and taking them to service and making sure they were cleaned and maintained and everything. Ended up selling that company shortly. After a while, sold that company and ended up with another opportunity to come back to New York and work on another startup. And that one was, it was great. I'd spent about 18 months there, and that one kind of ran its course. And I had always wanted to be an investor, and so it just got the opportunity to come work here at OpenView was just a great fit because most of when I refer to all this time I was spent in kind of startups and tech startups, it was all B2B software. Mm-hmm. And so when I was looking at through OpenView's website and chatting with some investor connections and friends, they just had such glowing reviews of OpenView and the focus that we bring as being real software investors. It was a great fit.
So what was it that attracted you to want to become an investor?
So one thing I didn't mention was I actually ended up pulling an internship in a VC fund that now does not exist, but at the time was. This was back when I was, I think it was in between like middle school and high school. It was pretty early, but it was fascinating. You're just having companies coming in all day and pitching their ideas and entrepreneurs, and they each one has a different vision for how things are going to evolve in the world and how they plan to capture a market and help make people's lives easier within certain businesses or consumer products or whatever it was. It was a general VC fund. And, it was such an interesting job. You get pitched on something and then the partners would come in and we would discuss what we thought about the opportunity. Is the market strong? Is it big enough? Do we think these guys are going to capture it? And it was just something that I thought, intellectually curious and like learning about things and like doing research on things, like taking conviction in ideas and running things to ground and then kind of placing some bets on it. It just seemed like a really interesting job. Mm-hmm. And, typically VCs tend to have a certain strain of ADD to us. We like to focus on 8 or 10 things at once. And this is a great job for those who have that.
Let's talk more about OpenView now. Give us a brief overview on what OpenView does.
Sure. So OpenView, as I think I mentioned before, basically we're expansion stage software investors. So a couple pieces in that get into. So software, typically software means you're selling software, and so it's going to be selling into businesses most of the time. Mm-hmm. Nobody really thinks of Facebook as a software company, although technically they are. So when we think about software, it's generally software sold to other businesses. Expansion stage basically means, look, you've solved a problem for your customers, and evidence of that is that they're buying. And typically they're buying, and a lot of businesses will purchase on a cycle. So you have like a 12-month cycle or a 6-month cycle or an 18, 24-month cycle. And so when you're at the expansion stage, it pretty much means that you've kind of come up on that cycle and you're starting to see most of these companies that we're buying have also renewed. So it's one thing to say, look, I'm going to buy Evernote. And they say, okay, well, you need 12 months and done. Okay, fine. It's whatever a month for 12 months. But then when you get to the end of those 12 months and the person calls back and says, we'd like to renew your contract, it's a pretty strong indicator of the value of the product to you as the consumer or as the user of the product if you re-up. Yeah. And so that's at the point where we really believe, that's a hard and fast indicator of product market fit. It's really easy for investors to say, hey, we only invest at the point of product market fit. But it's very hard to quantify that beyond, people vote with their feet. And so we like to see basically you're kind of at that inflection point where your customers are voting with their feet. And at that point, it means right around there. And so that's the expansion stage. And so what that means then is you have a real business at that point. Your customers are coming back. And so typically what happens there is you start getting this kind of pattern where your companies need to scale at that point. And typically in SaaS companies in particular, scaling involves needing money, because you've got all these sales and marketing expenses to try to bring on customers and customer success reps and sales development people, all these things you need to hire and you need to pay for, that you then need that cash. But because it's a SaaS business, you may not pay up front. So you may not see the actual value from that contract until far into the future. So a lot of times SaaS businesses require a lot of cash to scale. More than a traditional software business that would have needed the cash early on to develop the product. SaaS actually needs it during that expansion stage. So that's where we come in to really help that.
Okay.
We've got a whole second half of the platform of the fund that deals with helping companies scale. So we call that the expansion team. And so this is a team of, call it 20 or 25 full-time operators that only work with our portfolio companies in basically all of the functional areas that expansion stage software companies have. And so, that could be product and engineering, could be go to market, helping you with sales strategy, helping you find business development representatives. Product and engineering could be helping you implement Scrum. It could be helping you find coders, product managers. Anything in there, you can help you with. We've got a finance team that helps you with finance. We've got a corporate development team that can help you with, M&A down the line. So it's kind of all the things that are very specific to that stage and very specific to the sector of software. And as a result, not only do we invest very, very specifically, but we can also help in those specific ways that companies tend to see.
Why the focus solely on software companies?
So, it comes out of, first of all, we were established as software investors, but the focus, we believe that all the success we have comes from that focus. So just as I was kind of alluding to before, which is you've got all these factors, these kind of roadblocks or these speed bumps or twists and turns that software companies have as they scale. They tend to look relatively similar across the broader software ecosystem as companies are at a specific stage and scaling through that specific stage. And so really where we can help bring value and where we also are very good at investing is companies that look a lot like software companies. So you'll see there are specific verticals that we don't really get all that involved in. Healthcare would be one of them, because companies that scale through there don't look like other software companies. But whether you're talking about something, that's infrastructure monitoring software like Datadog, or it's very specific vertical application software like VTS for real estate, those are completely separate companies. But the issues they'll run into, by the way, totally separate go-to-market models. One of them, Datadog, is totally product-led. So you have people that are signing on and then it's expanding through the organization. VTS is a salesperson-led product company. So you've got basically salespeople going and selling it. But those companies, as they scale, will have very similar issues because you've got to put in place the processes to run a software company and to scale it. And so that's really where we've gotten heavily involved in pretty much all of our portfolio companies.
So what are some of the pros and cons of focusing solely on software companies in expansion stage?
So there's two. So from an investment standpoint, focusing so closely on a very specific sector and a very specific stage, so expansion stage software, means that over time you get your pattern recognition, you get very good at it. We can basically run a coverage model, which is a pretty common model you see across some of the mid to later stage firms. We can run that with fewer people than looking at like an Insight Venture Partners would have to run. You also get very, very good at quickly looking at the metrics that matter and judging which metrics matter for which companies. And they're not always vertical specific. Sometimes they're specific to each individual company. And so, you can look you can figure out the quality of an opportunity. You can also start making judgments on that company's ability to scale. And then in turn, we can provide that back to CEOs when we give them feedback, positive, negative, or neutral, on here's what we see in the company. Here's what that looks like, to us from a market standpoint, from a scaling standpoint, go down the list in terms of diligence, and you can generally provide pretty good feedback. Now that's the investment side. On the operation, on the scaling side, because remember, half of what we do is involved in just scaling companies through this expansion stage. Our operators only work with companies in the expansion stage. So they're solving all of these problems that typically happen. So, one of the person who leads our go-to-market practice, was at NetSuite before and scaled their BDR team from 0 to, I'm going to get this number wrong, but I think it was 170 people. So talk about someone who knows the problems and the speed bumps and how to scale an outbound sales operation. That's a perfect example. So we've got several companies that are doing exactly that. Who's the best person to do that? Someone who's done it before and knows how to do it. Now, you also asked the pros and the cons. So the cons, the downside is that you're limited in what you can do. And so, typically people become VCs for all kinds of reasons, but the one thing that you see invariably is to be successful in this and to enjoy doing it, you have to be intellectually curious and to a level that's somewhat extreme for like a normal person. And so typically it's you just love learning and you love doing research and you love new things and we over-index in that area. But that becomes really tough then to see all of the companies that are doing, interesting things in e-commerce or self-driving or consumer products. Most VCs wear Apple Watches and have iPhone 6S Pluses. I was in the startup industry before this, and most people didn't have the larger version of the phone. The first thing I noticed is when I got here is everybody's carrying the larger version. It's just people are interested in the newest thing, the better thing, and optimizing towards it. Mm-hmm. But you can't actually invest in that. And so, because you're only investing in that one thing.
I think it also allows you to not get distracted by other industries that are going on. So if a company is coming along and they're raising a round and say they could be, that it's normally, if you weren't focusing only on software companies, it might be something you'd invest in. It allows you to not get distracted by that. By focusing only on the software companies.
The easiest thing for us to say no to a company is to just say, look, love the idea. Mm-hmm. And unfortunately, we don't invest in that.
Yeah. Are there any mistakes that you see consistently made by entrepreneurs?
So this is an interesting one. Typically, you don't see, there's a big gulf in here between first-time entrepreneurs and repeat entrepreneurs. Repeat entrepreneurs tend not to make the same mistakes that first-time entrepreneurs make, for good or for bad, or for good or bad. But first-time entrepreneurs tend to make mistakes in the fundraising process. There can be all kinds of mistakes, but the biggest one is to just not realize that it's totally a person-to-person endeavor. And so you just have to treat people like good people, and generally that's an easier way to do it. But there are a lot of little tips that you can make to make the whole thing go better. I think if you interact, and this is a common thing for first-time entrepreneurs or people who not necessarily were the CEO last time. They might have been somebody who was in the organization but didn't actually see the fundraising process happen. Mm-hmm. So it can be extraordinarily successful, and they may be successful in the future. It's really easy to hit a couple of roadblocks if you treat the potential investors as too adversarial, or you try to make them jump through hoops just to prove who you are or anything like that. One of the biggest diligence items for any investor, regardless of stage, is team. And so when you have investors, one of the things you will always see is, just don't think I could work with this founder. And that's a really kind of a scary thing, for the founder to have an investor judge that they're not the one. And frankly, most investors pass on most opportunities. So it's not like, if you get 5 passes and you've only reached out to 6 people, you're actually doing okay.
Yeah.
The one mistake that you see most first time founders make, I actually should back up there. Not most, but most of the time this is made, it's by first time founders, is to push back when an investor passes. So if an investor passes on your company, it could be for any one of 20 reasons. And they may not tell you. They may tell you specifically the concern they have. But sometimes the concern they have may be sensitive to what, you as the founder is saying, because who knows, maybe that feedback is, I don't feel like the problem you're solving is important, or I don't feel like you're the right person to solve it. Or it could be this market is really crowded and you're not showing any differentiation. Those are all really common for VCs to pass on companies. And, probably the most common one is, well, it's just too early. Well, it's just too early could literally mean you're before our screen. So all investors have a screen of some sort. It could be that you're too late, but that's a very common one. But it's also an indication that you as a company have not proven what that VC feels like they need to get behind the company. But what you find is that sometimes founders, CEOs will try to push back against the VC and say, well, I don't think you really saw the opportunity the right way. Or let me see if I can repackage this in some way to, make you reconsider. There's a couple of problems here. First one is it's very difficult to argue with someone and actually change their mind. And frankly, when you are pitching an investor, that investor has to then go be your advocate to his entire investment group. So if you can convince that person to change their mind, and then they actually have to go back and not only admit they were wrong, they now have to go pitch their entire group. And in the back of their head, they're thinking that you proved them wrong. That's a really, really hard sell and works about 0% of the time.
Yeah.
So just on a very human level, that's kind of the toughest thing. The second thing is, the one thing I noticed coming from the entrepreneur side to the investor side is that entrepreneurs tend not to realize how many companies VCs see, how many they talk to in how many different industries. And, VCs spend their lives looking at companies and looking at opportunities. And so they become very, very good at picking out yellow flags, green flags, red flags, and seeing through smoke screens. And so, if there are questions they ask and you don't give a factual answer, or you give an answer that's kind of slightly spun, or instead of telling them, if they ask for your annual recurring revenue number and you tell them bookings instead, that's a specific sign. And it could be that you misheard them, but it also could be that your ARR is not to where they need it to be. And you're just telling them bookings because you're actually using multi-year contracts. So your bookings will be bigger than your ARR will. Because you could do a 2-year contract, $1 million 2-year contract comes in as $1 million booking, but that's only $500K a year. So, or if you're cagey on numbers, a lot of times early stage CEOs that haven't done it before might be cagey on numbers. They could just say, well, I don't want to tell you my revenue number. Frankly, newsflash, no one cares. We've talked to 7 companies today. We've gotten revenue numbers from 6 of them. The fact that you're not telling us does not make you any better. In our mind, it just means, okay, now we got to jump through a bunch of hoops to find out what this revenue number is. You want to make this as easy as possible on your investors, because if you make them as easy as possible on them, they'll make it as easy as possible on you.
Yeah, I feel like you would want to cooperate with someone that you want to invest in your company, right?
Absolutely.
Not try and push back on
Absolutely.
them.
Anytime you push back on a VC, that's a negative sign to them, because think about it. They're figuring out whether to partner with you.
So what are some of the metrics that you look for when looking at making an investment?
So it typically changes for every company. We have some screen metrics that we have to look at to qualify a company as being in the expansion stage. So typically what that looks like is the biggest one to look at right off the bat is annual recurring revenue. So typically, that's a run rate. And so you're talking about basically it has to be over $1 million a year in annual recurring revenue for us to really even get interested in it at all. And then, usually it's going to be somewhere between 2 and 4, 2 and 5, where we start getting interested. And then above that as well. But that's kind of the lower barrier on ARR. And then the corresponding monthly revenue that goes from it. Sometimes businesses, depending on their sales cycle, will report as MRR. That's fine. Roughly 80K is right where you get to about $1 million a year. That's roughly the equivalent. The big metric that we tend to look at across almost all SaaS businesses is a metric called net dollar retention. So this is a somewhat derivative metric, and it's one that's very common in this expansion through growth stage investors. But you don't see it early on in early stage investors because it requires a lot of data. And basically it's saying, look, if I sign you, Nick, up as a customer tomorrow and you're paying me $1, what are you paying me in 12 months? Are you paying me $1? Are you paying me 75 cents? Are you paying me $2? Is it $3? What about in 24 months? And so, the absolute best companies out there, if I sign you, Nick, up as a customer in 24 months, you might be paying me $3.50 on that $1. Mm-hmm. Now, the great thing about that is that's not a new sale. That's either organic expansion or upsells or cross sells within a company. So that's not selling into a brand new account. So as a result, your company can organically expand without any new sales. That's a really big deal within SaaS. And so that actually kind of turns itself into, well, what happens if it's 75 cents? Well, the problem with that is if it's 75 cents, then in 2 years, you've lost half your customers from a dollar standpoint. So we look at a ton of different things, but that's kind of the one metric that when you look at, you can either get really excited about a company or you can kind of see the gas run out mm-hmm. on a deal based on that kind of thing.
So if it was 75 cents after 2 years, then, and if say their revenue is still growing, it'd be from sales, right? Not from the organic growth. Like
So let's take a really easy example. Say that you only have, every year you have 25% churn. Mm-hmm. So on a dollar basis. In other words, you sign up basically $100 worth of customers today.
Yep.
Those customers that signed up today in 12 months will collectively be paying you half of what they were paying you on that first day. So that could be for a number of reasons. They could actually just have, minimized their accounts, although that's not normal. Usually it's that half of them just stop paying. So say that happens. Say it's 25%. So it's 75% in 1 year. In 2 years, that's down to 50%. That means that you've lost half of your customers that you signed up today. And that means you're going to need to resell into new accounts.
Yeah.
To get those back. So just to get back to where you were today with that one, what we call a cohort to sign up, you need to sell half of it again in 2 years. So the problem with this is that SaaS businesses don't get most of their revenue up front. They get their revenue from the long-term value of these customers. So if you lose customers, you're losing that long-term value. The basic reason why SaaS companies are thought of so highly from a valuation standpoint is because every single customer builds on your revenue streams. And which is more, it's just a subscription revenue. That's the nature of subscription revenue when done well. And so anything you can do as a company to reduce the churn of your customers is something that, will accrete in value in huge ways over time.
Do you have any, what we'll call like deal stoppers for you? Whereas, if a company has this one thing, it just kind of, you wouldn't consider it?
Sure. So there's probably more reasons not to invest in any company than reasons to invest in any company. But the one big one, and this is going to sound familiar, the one big one that we see that can turn an otherwise great company off is churn.
Okay. And
that's just in a SaaS business. You can be an incredibly successful SaaS business. And if you're losing, as I mentioned before, if you're losing a bunch of customers, you're going to have a really hard time finding investors that will jump on board as you start to scale.
Do you find for the reasons for churn, do you think that it's usually because of the product, or is it because of like the customer experience or the service that they provide?
So, it's a really good question because it leads kind of somewhat into this idea that churn tends to represent how interesting, or inversely represent how worth a product is to you. So, if you've got, and this is part of the reason why everyone's looking for the next Salesforce all the time, is because you've got this kind of single source of truth in data, and you've got this data repository. Anything that's incredibly important to a company will never let lapse. And so anytime that a company lets something lapse, it's an indicator that people are voting with their feet. They're saying, this is not interesting enough to me. People still use email every single day.
Yeah.
10 or 15 or 20 or 30 years after it was invented. That's a pretty sticky product. Now it's free in most cases, but that's it. But any time that you've got people still using a product after a long time, that's an indicator of how interesting that product is. And so yeah, that's absolutely.
So I think there's a lot of companies out there that are, they have their product that could maybe really be a feature instead of a product. How can founders determine whether their product is just a feature or if it actually has the potential to be a company itself?
So this is a really hard one. You'll find a lot of investors will tell you, hey, this really seems like a feature rather than a product in itself. And to me, that's a pretty easy thing to question, which is, okay, what's it a feature of? And if you can name what it's a feature of, it could be a feature. If that feature is incredibly valuable, could also be a product. And so it's a hard one to say, but you can pretty much validate that based on a couple of quick tests and talking to customers, and really how do they see the product? Does it change something that they do? If it does, it's probably a standalone product.
What do you think separates a great founder from a good founder?
This is a really interesting one, because in order to be a great founder, you have to not only have a great vision, you have to be able to sell that vision, you have to be able to lead people, and you have to be able to scale as the organization changes. And so, where we invest is really somewhat at an inflection point with your scaling of your company. So a lot of times what we look at it are founders that have very quickly created an incredible product and gotten a bunch of people to get behind them. And we're in a very privileged position because we get to look at that and say, great job. But we can also look at it and say, but I don't believe you'll be able to scale with this organization as it goes. Now, we would never tell somebody that to their face, but it's something that we have to have conviction within ourselves that that person will be able to evolve as a leader as the organization scales. And the thing is that a lot of people don't realize is a 10-person company is completely different than a 30-person company, is completely different than a 100-person company, could not be more different than a 10,000-person company. And so to get a truly generational business, you need to have a founder that can do all of that. And there are just so few people out there that can do that, that really can do that. And a good founder is someone who can get the business to a certain standpoint or a certain point, and then we bring in a professional founder, but that's not how we prefer to do things.
You prefer to have a founder that can then scale with the business in that executive position?
Frankly, no one wants to go try to find a CEO. The captain of the ship is the hardest position to replace.
Yeah. I'm interested in what your view is on this. Do you believe in sales or a product-led growth for a company?
So we like both.
Okay.
Product-led growth, and we actually have done a lot of work into both because we support sales-led organizations very strongly at OpenView, as I was kind of mentioning earlier. But we also have several companies that are extremely strong market leaders in product-led growth. Datadog, Expensify, a couple others. And product-led growth can be an incredibly efficient way to scale and scale fast. But it also depends on whether that's right, because product-led is totally bottom-up. So you have to be able to onboard users and then have those users share that with other people. Many products out there just don't work that way. It wouldn't make sense to do it. Take, the classic example, take Salesforce. Salesforce, you would never just have 2 people using and then grow it internally. It doesn't work that way. You have to use it for the entire organization for it to work. So I think it very, very much depends on the company. But at the same time, all companies are going to need sales at one point to achieve sufficient size. And the reason for that is basically, look, what happens when your growth that occurs naturally stalls. And it always does, because it always gets to the point where you're going to have, basically three types of people that will buy a product. There's going to be, say you're selling a screwdriver. There's going to be the first couple of people that are going to just buy that screwdriver as soon as they see it, because they've got a bunch of screws that need to be screwed in and they see exactly how that screwdriver is going to screw in that screw. And then you've got a bunch of people that will, as soon as they see other people doing it, they'll start thinking about how they might use that screwdriver. It seems interesting. And, they're seeing a lot of marketing materials for the screwdriver. Plus their buddy Nick down the hall just told them they ought to buy that screwdriver. And then they look in their drawer and they've got a bunch of screws. That's the kind of that's the referral kind of customer. All that's product-led growth, and that's awesome. But you're going to run out of those kind of people eventually. Eventually, you're going to have this whole class of people that is actually a much larger gross number of people that are frankly going to need a human to describe to them why they ought to use a screwdriver versus a hammer, and why that screwdriver is going to bring value to their business and why it's worth paying, and then helping them find budget within their organization to do it. And so almost all companies, I don't want to, anytime you say all, you're going to be wrong. So I'm not going to say all companies, but almost all companies will eventually need some sort of sales organization, if not just to continue to make sure that you're pressing that growth.
What advice would you give to a company that has had their sales stall? Like, what should they do? What should they look at specifically to turn that around?
Unfortunately, it's entirely company specific, because without knowing what their situation is, at what size they stall, their issues could be so systemic or not systemic. It could be relatively easy to solve. That's a tough one.
Okay. Now we touched a little bit before on this, but I want to know how important time distance to value is for you to invest.
So, it really depends, because we kind of look at some of those things as, say, the time distance to value is long, but the customer is going to pay you an enormous amount because it's incredibly valuable to them. And they're going to be customers for a very long time. Well, that return could be great to you. And so, it really needs to correlate with how easy it is to get the customer, and then how long the customer will be there, how much money the customer will pay you. Mm-hmm. So just the time to value distance itself is not even really a metric. It's just a measure. So if we talk about, long-term value of a customer is just a measure. It's just how much is this customer worth to you? You have to correlate it to something. What's the customer acquisition cost? That's just a measure. It's not really a metric in itself, because it doesn't matter if it takes me $1 million to sign you up, Nick, but you're gonna pay me $1 million a month. I'll take that.
Right.
Yeah. Or if it takes me $1 million in a year to sign you up, and you're not going to see, so we're not going to really see much value from you until the third year. But on that third year, you're going to be paying $1 million, and we can prove, because we actually have enough evidence of this, that you're going to be scaling that $1 million to $2 million and $10 million. After that could be a great investment.
Where do you see application software headed over the next 10 years?
Man, that's a hard one. I think that we're at an interesting inflection point right now with AI that's very similar to where we were with big data, where everybody believes it is the golden bullet that's going to solve all the problems. I don't know that I believe that. I think that AI will allow us to automate a lot of repetitive tasks and to get insights from things that we otherwise wouldn't have necessarily got. So it's kind of like a natural evolution of big data, especially because you need a huge amount of data.
Big data for
you don't need necessarily big data by name, but you need a lot of data to train your systems, whether they're machine learning or NLP or anything like that. And so, I'm not sure I totally buy the whole buzz around the whole, Silicon Valley and AI and everything. And if you actually speak to the people that are doing it, I think where the reality is pretty different from where the buzz is at the moment. Mm-hmm. But there are some really interesting things out there, making use of text recognition, for instance, where you can write a paragraph of your thoughts, and it can pull sentiment from it. It can pull meaning from it. And what you can do once you actually have that sentiment, extracted from that data, and you can have the meaning extracted from that data, is pretty significant.
I want to talk a little bit about valuation, and does valuation play a role in your decision-making process here?
Sure. So the biggest issue with valuation is that valuation correlates directly with your outcome as an investor. And so, as an investor, we're looking for multiples of whatever of our fund, basically. So we have a fund of a certain size, and we want to return that. 3x for a venture fund is kind of that's kind of like the standard. If you can hit 3x, that's good. You'll be doing well. If you can go up above that, that's like you're great. And so as a result, you need all your companies to do pretty well. And we only make 3 to 6 investments a year. And so we expect, over the course of that fund, each one of those companies is going to do well. And some are going to do really, really well. Some are going to just do really well. And then some are going to do well. But we don't do that typical venture model of one company return the fund and give us all the, basically make us all money. And then all the other companies just let them go. So as a result, valuation really matters. If we take a company that's, on a $20 million pre-money valuation before we put our investment in, and we double that, that's halving our returns right off the top with the same outcome. And so what could go from a 6x could all of a sudden go to a 3x, or even more realistically, a 3x goes to 1.5, or a 4x goes to 2. And that is something that we actually will pass on companies from sometimes, which is we get a company, we like everything about the company, but we believe that given its projections and, its ability to convert its pipeline, what its pipeline really is right now, we think that basically saying their valuation right now, they've baked in all of their growth and their upside above what they've already done into the price.
Okay.
And so in a great exit scenario, we're not making any money, really.
Mm-hmm.
And as a result, look, we love doing what we're doing, but we have to think about exits. We can't just invest in a company because it's cool and because we think it's a great company, unfortunately.
Do you think that sometimes companies, founders can go after, when they're raising money, try to raise too much money?
This is a tough one, because with money comes expectations. And the more money you raise, the more you dilute yourself. And especially where we are, typically there's going to be seed investors involved. A lot of times there's going to be Series A investors involved, sometimes even Series B investors involved before we get involved. So if you raise more money, then, if you need 10 million and you raise 20, you're adding a lot of dilution to the cap table, much to the chagrin of your investors. And so, your investors, you're going to end up with the people who gave you the money now are giving you 20 million because they think you have something to do with that 10 million. And so there are going to be that increased expectations from you raising more money as a result of, and then also you're going to end up with your existing investors saying, okay, that's fine, but you need to understand that you need to more than overcome the dilution that we've taken from this. So you need to basically, given what you thought and you needed 10 million, what you thought you were going to do in your projections, now you need to do even better, because we need to make up for the fact that we now own less of your company.
So along with that, do you actively advise your portfolio companies when it comes to follow-on funding?
So the way that we work as a fund is we write, $5 to $20 million checks typically. And so at that size and at the stage we're investing, which is usually large A's through, some small C's, we're going to lead the round, and we're going to take a board seat. And, when you have a board seat, that is a natural evolution of that is to be an advisor in the next round.
Mm-hmm. So you mentioned before how important it is for you to have a great team for the company. How does a company go about building a great culture?
Culture is a really hard one. And, I think that's one I almost don't even have a good answer for, because there are so many different ways to do it. There are so many Harvard Business Review articles out there about how to scale a culture, and so much opining done, a lot by VCs actually, and a lot done by former CEOs on how to scale culture, and just hiring is so important, and it's so hard, and everybody does it wrong. There's a great Google's VP of People, I think is what people operations, Laszlo Bock, has a great interview. I think it's with Kleiner Perkins' podcast, where he talks about their hiring process versus anybody else's and their view on people. And Google has pretty consistently hit it out of the park with their hiring. Nobody gets everything right, but they've done pretty well. That's an interesting recommendation if you're looking for one.
The software companies, when they're in the growth stage, right, they can oftentimes outgrow their technology and their operational procedures pretty quickly. So how can a company prepare for that?
Scalability of technology is really hard, and typically your kind of Series B, Series C investors, we're going to do a lot of due diligence to make sure that your technology is scalable to the point, where you don't need to re-architect it to get to significant scale. I don't know of a company that we've invested in that we knew beforehand going into it that they would need to re-architect. In fact, I actually don't know of a company, although it's probably just my ignorance, that we have invested in that has had to do that to get there. But companies are going to have to do what you're going to have to do. And, frankly, we would hope that we would never invest in a company that had to completely re-architect their product to scale. Now, scaling an organization, that's actually somewhat easier because you can put into place, you can just hire people that I make it sound flip to say you can just hire, because hiring is very hard. But you can focus on hiring people that have scaled organizations before, and people that are really in that, in the stage of where you need to be to get, to where you want to go. So if it's someone that needs to help build a sales organization, or someone that is going to start putting in, lean development practices, there are certain practices that have been put into place that we can help with, and that we can help with hiring with people that know how to do, that can help scale an organization and really turn it into a professional company from just a group of people that have a great product that have just a bunch of customers.
Mm-hmm. Now, let's say that you're a B2B SaaS company, right? How can you make sure that your customers don't outgrow you? As they grow bigger, you're able to scale with them. Is it the same thing along the same lines?
So, I think it's an interesting question. If you're doing it right, you're going to be selling into companies that are progressively larger and larger. And some companies certainly are just going to go straight at enterprise organizations, and then they will never outgrow the product. But if you think about a company like, I'll just give you an example, Expensify. So Expensify started as kind of a small and medium enterprise expense reporting software and financial management software around expenses. And it has gone kind of somewhat upmarket and also just grabbed a huge amount of that SME market. But, there's over time, as you develop a product, you develop features that can work with more enterprise customers. The question there, though, is almost like, I almost might rephrase the question and say, well, what happens if your product is used by a lot more people within a single organization than you ever anticipated? You need to make sure the product can scale.
Do you think it's okay sometimes for a company to outgrow, or for a customer to outgrow a company? Or do you think that they should always be able to keep them on as they grow?
So one of the problems we see some companies having, prospect companies, is they come to us and they just say, look, I'm raising capital because I don't have enough people to handle the customers that I have. As investors, your investors almost always like that, because that's an indicator of future growth. If you can only if you got 3 customers that want to sign on right now and you can only get 2 of them,
you can't handle them.
You got one for next month. And entrepreneurs don't like that, though, and for good reason, by the way, because they still are stuck with 3 customers that they can't serve. They can only serve 2.
Yeah.
But from a growth perspective, that's not necessarily a bad thing. It's a stage specific thing.
I want to move now into our rapid fire questions.
Absolutely.
All right. What's a startup in Boston that you're most excited about?
So I can't give you prospects, but I can give you a portfolio company that I really like.
Okay. Give me one in your portfolio and then one outside your portfolio.
So one that I think is really cool within the portfolio is a company that I mentioned before called Datadog. They are actually New York based, but they've got a huge area in Boston. Their entire product and engineering team is in Boston. They're just solving a problem for DevOps teams in a way that I just don't think we've really seen it, much before that. Outside of it, I'm going to defer on this question because I'm really excited about a couple of them, but I can't tell you because I don't want anybody else taking them.
Okay, sure. What's something about you that most people don't know?
So I grew up outside of New York City, but I'm a huge Minnesota Vikings fan. And it's the only sport. I'm a total New York sports homer. And then I bleed purple.
Except for the Vikings. What advice would you give for early stage software company founders?
So this is not a typical one coming from VCs, but only raise VC money if you as a founder want to have a VC style company with a VC profile exit. Most companies should not take VC money because most companies won't come to some close within 10 years, a positive close. So VCs need a rapidly scaled company at a much higher valuation than they invested in to make it worth their time. So they're going to demand that within 10 years, because a typical fund's horizon is 10 years, that you better either IPO or be bought for a big multiple. And most people out there don't want that. Now, there's a whole, kind of scene these days around people who are building companies that works really well for, and that's great. But for the vast majority of people, VC money doesn't make any sense.
I think that's a great point because you want your investors' interests obviously to align with your interests. You don't want those to counteract.
Exactly. And the smartest money out there, the best investors will make sure that they'll sit you down over dinner and as a CEO, and they'll damn sure that your mind is in the same place that their mind is. Mm-hmm. The not so smart investors will never do that.
Do you have any favorite blogs or books?
Yes. So basically for blogs, there are so many awesome ones. There are two that I read regularly. The first one is Tomas Tungus from Redpoint. His blog comes out every single morning. And it's just a nice sense of where we are as a VC industry. And also he's a SaaS investor. So it's a great, it fits very much with what we do. He led the round at Expensify before we did.
Okay.
So, he's got, he just takes basically whatever data is available, and then he provides you the data in a very easy, concise way and some of his takeaways from it. And I think that's just a nice thing if you're in the industry and want to know kind of the state of the industry, the state of funding, all these kinds of things. He's a great guy to read. Second one is Fred Wilson at Union Square. Just an awesome guy, and he just takes his thoughts. It's just his thoughts every single day, and it's always different. Sometimes it's about prospect or portfolio companies. Sometimes it's about girls in New York coding, and can be all kinds of different things. But just one of the best investors out there. It's just great to hear from him. Ben Horowitz's book, The Hard Thing About Hard Things, is the best business book hands down I've ever read. Yeah. And having been a CEO, having had to go through some of the hard times, he talks about the advice, the reasons for it, kind of the background into human nature that you get from that is just invaluable.
What are some of your favorite lessons that he talks about in that book?
So the one big takeaway from it in my mind is that people management's really hard, and you have to think about it that way. And the more that you can place yourself in somebody else's shoes and think about it from their standpoint, the better. So anything he talks about, it's always, especially in management, it's always, here's what happened, here's what I did, and here's what I should have done. Or here's what I did, and here's the mistake I made, and here is how in the future you should do it. Or here's how I did it, and this is why I did it, and this is what's right. And it's actionable advice, how to lay somebody off, really what to tell them. Don't butter it up. Tell them right away.
Yeah.
These kinds of things are really hard, and most people don't ever want to think about how do I lay somebody off until you have to do it. And then it's really hard.
What have been some of the most important things you've learned since starting?
So I alluded to this earlier, but the biggest thing that I've noticed coming from the entrepreneur side to the investor side is that there's a disconnect between most investors and most founders. Most founders don't realize how many companies VCs see, and most VCs don't realize how much work being a founder takes. So to break down each of those, VCs are seeing companies all day long, and just the numbers get staggering very quickly. So if you take an average, 2 companies a day, that's probably low for many VCs. 2 companies a day is 10 companies a week. 10 companies a week times 50 weeks is, 500 companies in a year you're talking to. Just probably directionally correct. If you took 500 swings at a baseball, you'd hit it a couple times and you'd start learning how to do it. And you start really developing a pattern recognition, and you can start seeing in pitches what's effective and what's not, and where people are kind of disguising things. And so that's something that I think if entrepreneurs knew that, had a better sense of that, they'd be a lot more open with VCs, because VCs don't care about what your revenue is right now. They care about what it is right now versus what it had been and where it's going. And it's a lot more likely that your company, when you tell them, they won't be interested in, and if they're not interested in it, they won't think about it again. So it's not worth it to try to get them to sign an NDA, or to try to be cagey with the numbers and try to allude to some, we're over 5 million and we're under 10 million in revenue. Who the freak cares? Just tell me it's 6.5. If it's 6.5 or it's 8.5, it's not going to change it will change my investment decision. But if I'm going to invest in you, you're going to have to tell me anyway, eventually. The flip side of that, I think most VCs, because they see so many companies, they see it as a repetitive process, and you start looking only at the anomalies, and you look at what's different as opposed to what is. And every entrepreneur that created something had to come up with everything. Literally every single thing. You had to come up with what font you were going to use. You had to come up with your, where on the web page are you going to put the title? You literally had to do every single aspect of your company. Somebody had to design. And typically in the early stage companies, that's the CEO. And so just the raw brute force that has to go into creating a company isn't often appreciated by VCs. It's the flip side of seeing so many companies.
Mm-hmm. And going back to your first point, of those 500 that you're seeing, you're only investing in 6 to 12 a year, right? So it's not
3 to 6.
3 to 6.
Yeah.
Okay.
So we don't invest in most of what we see.
Yeah.
And a lot of that is because it doesn't necessarily fit where we are. And so if we, just take up 500 companies, I don't, directionally, again, half, maybe, it's actually a lot more than that. It's probably 80% are just not within our parameters for where we invest. And all of that comes down to that focus that we have. And all of that comes from when we raised the money originally for this fund to invest in, we had to tell our limited partners, our LPs who gave us the vast majority of the money we invest, that we would only invest in specific things. And when we do, we have to then follow up on that. And that comes from their strategy, because they know they're investing in expansion stage companies when they give us money.
Yeah.
So if we go out and invest in consumer tomorrow, we get calls from people saying, hey,
what are you doing?
What are you doing? We already have exposure to consumer products through these other funds. We don't need you guys to be doing that. Plus, we want software at the expansion stage, and very focused. And so that's kind of the when you kind of walk it back and you try to say, well, why are you focused? Well, because we're good at it. And that's what we sold them on, and that's what they're banking on. And it all comes down to, our LPs are like our shareholders.
What advice would you give to your 20-year-old self?
This is a tough one. Don't be afraid to stick your neck out. I think if I looked back at my 20-year-old self, I would say, after, looking back and saying, okay, with all this stuff I've done, you fall down, you get scraped a lot, and it'd be a lot easier just not to fall down. But I think it's, you learn way more than you could ever know by going through all that stuff. And the more that you just kind of hold your nose and jump, the more you'll end up learning.
What do you think makes the Boston startup scene unique?
Boston has the most concentrated and broad level of talent and intellectual horsepower of any area in the world. And coming out of the universities. You've got MIT, just at MIT and Harvard alone, you've got unbelievable talent. And when you add in, your Tufts, your BU, your BC, your Northeastern, you've got just an incredible, and that's not even to mention the smaller colleges that some of which are excellent. Incredible amount of talent that coming out of here, and it's broad based. MIT is great for engineers and scientists, and we're going to need all those. But we're also going to need the people that can manage the people and the people that can help design the products. And those people tend to go to design schools or liberal arts schools. And we've got all that, and you're going to have to have arts people. I mean, we've got Emerson sitting in the middle of the town here. And so it's just the talent base, a lot of it leaves, unfortunately, but it's all young. So it's a great place to start because you can get people that are young. And when people are young, they're cheap. And cheap is a good thing for startups.
A couple more questions here to close out.
Absolutely.
Where can people find out more about OpenView?
So best place is our website. It's openviewpartners.com. And that is one that I highly suggest people go to because we have a huge amount of content that we have on our website from our arm that we call OpenView Labs. And that content is not clickbait. That is real, serious, actionable stuff. How to scale a product-led go-to-market practice, that kind of thing. Mm-hmm. We just published. I just saw come across the Twitter feed recently. The definitive guide to product-led growth. I mean, this is something that if you're just looking to read idly, don't read this. But if you're looking to scale a product-led growth company, you ought not to be looking anywhere else. Mm-hmm. So definitely try openviewpartners.com. Where can people connect with you online? Twitter. Love Twitter. What's your Twitter handle? KVEC7, KVEC7. Great spot to start. Otherwise, you can find my profile on LinkedIn or on our website, and you can follow it to Twitter there. But I spend a huge amount of time on Twitter, along with all the other VCs. Do you have any parting thoughts, advice, or suggestions for the audience? No, I'm just happy to be contributing in any way, and it's great to be able to kind of give back to the scene, and looking forward to seeing where it goes. Ken, thank you so much for coming on the show today. It's been a real pleasure. I've learned a lot, and I'm sure that the listeners will learn a lot as well. Pleasure to be here. Thanks for having me, Nick. If you liked today's episode, be sure to subscribe to the podcast on iTunes. You'll get all my new episodes as soon as they're released right on your podcast app. And if you really liked today's episode, it would mean a lot to me if you could write a review of the podcast as well. Just go to startupbostonpodcast.com/iTunes. And remember, you can find all show notes with links at startupbostonpodcast.com. Until next time, if you have any feedback, ideas for guests, or just want to say hi, you can reach me at nic@startupbostonpodcast.com. Or reach out on Twitter at StartupBossCast. That's Startup BOS Cast. Cheers.